Hello students, welcome to Account-Wise Academy. This is Latha Venkateshwaran. In this video, I will provide a simplified explanation about weighted average cost of capital to ensure that you can understand it effortlessly. Topics to be covered are capital, cost of debt, cost of equity, cost of capital, and finally we will derive at the formula of weighted average cost of capital. What is capital? We all know that we need money to start a business. That initial money which we use to start the business is called capital. We need capital to get things going and to make our business bigger. It's something like fuel that helps us to create stuff, offer services and make more money down the road or in the future. We can get capital from our own savings or from people who invest in our idea. This investment can be mobilized from external investors or external investments called equity, or from loans. They can also be called as debts, or from any other sources. We need capital for building and expanding our business and for achieving our personal goals. Achieving personal goals means maximizing profits. We saw in the previous slide that capital is obtained either as a debt or as an external investment. Now let us see what is debt. When we use debt for our investment, it's like getting a loan or like borrowing money. You must give the money back later, and usually you also need to pay a little extra money called interest. You often get these loans from a bank. What is equity? We know equity is an external investment. So, equity holders become our investors or co-owners and they give us money. You don't have to pay this money back like a loan. Instead, the investors expect a return on investment in the future. Let us learn about cost of debt. Cost of debt is like the fee you pay for borrowing money. It is extra money you have to give back on top of what you have borrowed, and usually it is called as interest. So, it is the expense you have to cover for using someone else's money. We know that debt is usually taken from bank. The rate of interest at which we borrow money is called cost of debt. Let us assume for our example cost of debt as 8%. What is cost of equity? Just like you expect a return when you put your money in a savings account, shareholders want something in return for investing in company stock. This reward is the cost of equity, and it is a minimum return or profit shareholders expect to make from their investment. So it's a minimum return or profit they expect from the investment in the company. Usually cost of equity will be more than cost of debt, as the investors expect more return than the bank interest. This is so because risk in investing in equity is higher. Here risk is higher when compared to debt. Let us take this minimum profit that the shareholders wants to earn is 10% for our example. Now let us see what is cost of capital. Cost of capital is the smallest or the lowest level of profit that the company can expect to earn from its new project or factory. If the company cannot earn this profit, then it may not be feasible for the company to proceed with it. We know that a company can mobilize funds from equity or from debt. If the company has mobilized funds only from debt, then the cost of capital will be 8%. We saw in the previous slides that cost of debt was 8%. So, if the company has mobilized funds only from debt, then cost of capital will be 8%. If the company has solely relied on only equity for raising its finance, for setting up a factory or for setting up a new project, then cost of capital will be 10%. Company may not only use equity or only debt for funding the project. Mostly, companies go for a combination of both equity and debt. For example, let us assume that the company has mobilized 30% of its funds from debt and the remaining 70% by using equity. Then we cannot directly say cost of capital as 8% or 10%. So cost of capital cannot be directly taken as 8% or 10%. This is wrong. Now we have to find the weighted average cost of capital. Now let us know how to calculate weighted average cost of capital. The formula for weighted average cost of capital is WACC. So that is the short form for weighted average cost of capital is equal to D by V into RD into 1 minus TC. So all these two things we will take in one bracket plus E by V into RE. First we will calculate these things and then we will calculate this and then we will add these together. So all these alphabets might be looking very confusing, but it's not so, it's very easy. Let's see how it is calculated. Here D by V is the proportion of debt. We know from the previous slide that the proportion of debt is 30%. RD is the cost of debt. So we know cost of debt is 8%. What is TC? TC is the corporate tax rate. So for our example, let us assume that this company falls under the tax category of 35%. EV is the proportion of equity. So now you can tell what is EV. Yes, EV is 70%. RE is the cost of equity. You can all tell what is RE. Yes, correct. Cost of equity is 10%. Now what we are going to do is we are going to take all these numbers and substitute in this formula. So what is D by V? It is 30%. RD is 8%. 1 minus T is 1 minus 35%. Plus this will be calculated separately and this will be calculated separately. E by V is 70% and RE is 10%. What is 30%? How to write 30% in decimal? 0.3. 8% is 0.08. 1 minus 35% is 65%, which is 0.65. 70 plus 70% is 0.7 into 10% is 0.1. So first this multiplied, what do you get? 0.3 into 0.08 plus 0.65, you get 0.00156. This multiplied, you get 0.07. So when you add these two things together, you get 0.07156, or in percentage it is 7.156. So cost of equity, cost of capital is not 8% or 10%, but it is 7.156, and it is called as WACC, that is weighted average cost of capital, because our project was funded with both equity and debt. Do like our video and share it with your friends if you find it helpful. Subscribe to our channel, which will encourage us to make more videos like this one. If you would like to inquire about the accountancy classes which I take, or to get more worksheets for problems with solutions, contact us at acct.wiseacademy@gmail.com. Thank you for watching.